Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hey everybody, you get a double dose of the Daves today. It is me on the East Coast and our other buddy Dave on the West Coast. So first, spreading the East Coast love here with my top stock pick of the week. It is Molson Coors, ticker TAP. Let's go ahead and take a look at Zacks.com and inspect and see what it is that I'm seeing in this stock. So Molson Coors, ticker TAP. It is currently a Zacks rank #1 strong buy. And look at these style scores. We have value style score of A D for growth, a C for momentum, VGM composite of B. Now, the alcoholic beverages industry is in the top 36% of our Zacks industry rank. So that means it's not just Molson Coors that is experiencing some good times here, but the industry as a whole. Now, that may come as a surprise given the fact that, well, a lot of these restaurants have been shut down, operating at reduced capacity due to the pandemic. So initially, we thought that was going to be a problem for companies like Molson Coors. But apparently, that hasn't been the case. People are transitioning, making their purchases at home. Look at what happened last quarter. This EPS surprise comes in 138% to the upside. What does that mean? That means that analysts have a really low bar for this for whatever reason. And last quarter, at least, Molson Coors, way better than that low bar. Here's something that I want to point out. This is the price consensus and EPS surprise chart for Molson Coors. Now, not what you want to see. Negative revisions coming in from analysts and a stock price that's going down. So Dave, why are you talking about it? Well, look, what have you done for me lately? And if you see, it appears that estimates have bottomed out. That happened a few months ago already. And they've begun to tick higher, not just for 2020, but also for 2021. So you have this movement higher in estimates. Okay. Well, we know estimates go down, stock price goes down, right? So if estimates go up, stock price should be going up. It's not the case. We have a divergence between the stock price and what's happening with earnings. That is an opportunity, I believe, in the shorter term. As these estimates tick up, should they continue to move higher, that eventually will compel the stock price to move along with it. So as long as there's this relationship with positive earnings estimate revisions, negative stock price, I believe eventually the rubber's going to meet the road and this thing is going to turn around and Molson Coors will be back to the heights of the Rockies. So that's my top stock pick of the week right now. We'll send it over to the West Coast for the other Dave.
Hey, thanks, East Coast Dave. West Coast Dave here with my top stock pick of the week, and it's the electronics and appliances retailer Best Buy. Now, when I look at stocks, I look for adaptability. Business conditions change, economic conditions change, consumer preferences change. And the businesses that adapt and change along with them are the ones that generally make the best long-term investments. So Best Buy, 5 to 10 years ago, was basically left for dead. They had become known as the shopping warehouse for people that were going to buy online, who wanted to go pick out their goods in person, take a look at them, and then go home and buy them a little cheaper from Amazon or similar online retailers. So that's obviously not an enviable position to be in. But Best Buy took the fact that they had a large number of brick and mortar stores, which in some cases were fairly expensive. It costs a lot more to rent those retail spaces than it does to rent the warehouse space that the online retailers utilize. And they made it a strength of theirs. They beefed up inventory and on-demand delivery. They made it so that you could buy anything that you wanted from them at a price that was very competitive with the online retailers. And you could go to the store, look at it yourself, pick it out. You could also return or exchange it. You could get repairs done, and you could use their team of technological experts to help you set it up, the Geek Squad. So Amazon can't quite compete in a lot of cases with the way that Best Buy is operating right now. So Best Buy is adapting. That's in the long term. In the short term, Best Buy has also adapted to the store closures and movement restrictions due to the COVID-19 pandemic. So Best Buy has seen even mild increases in sales during the pandemic as people upgrade computer equipment, audiovisual equipment, appliances, everything around the home where people are spending most of their time now. A lot of those things you can buy at Best Buy, and customers are. And then Best Buy also turned their stores, even if you couldn't shop in them in person, into basically on-demand warehouses. So if you wanted to buy something online, you could pick it up same day at Best Buy, drive your car into the parking lot, text a code that had arrived, and a Best Buy representative would bring your products right out and put them right in your car. So it became even, in many cases, easier than shopping online, and you got your stuff a lot faster. Now, the most recent quarter, Best Buy turned in a huge beat, and the stock's even been down a little bit since then. Now, earnings estimates have been climbing over the past 60 days. They're up from $5.65 a share for the full year, all the way to $7.12 a share. So that's a 26% increase. And yet over that same period of time, the stock's only up about 9%. So this is a legitimate value play right here. The stock, you would expect the stock to be up at least as much as the earnings estimates are up. Now, in the most recent quarter, they're expected to earn $1.09 a share. They're at $1.71. It's a 57% beat. Sales growth is, again, fairly modest, low single digits, but earnings growth is through the roof. Solid double digits gains in earnings due to the fact that they've lowered their general and administrative expenses during the pandemic. So again, adaptation. They took lemons and made lemonade. Balance sheet. Best Buy has about $5 billion in cash and just over $1 billion in debt. Now, that's pretty rare for a retailer. Retailers don't generally have a lot of cash on the balance sheet. And that allows them to pay a 2% dividend that's solid and really almost unheard of for a business in this category. So in general, Best Buy, adaptation. They take on whatever the market gives them, whatever the economy gives them, and they keep churning out profits for investors. And that's what makes them my top stock pick of the day.